The XLK Technology ETF's 14-day RSI just hit 80 for the first time in nearly 4 years. We're going to discuss how important this is to technology going forward and also the significance it has on the broader market as well. So when we hear that the 14-day RSI is this high, we know it's stretched. And stretched, of course, is another word for being overbought. Overbought really has a negative connotation, whether we like it or not. It suggests that buyers have been exhausted and that things are overdone because of too much buying. And really, depending on what market we're in, that could be true. We all remember 2022 when some very sharp bear market rallies produced extreme readings for some RSIs, depending on where you looked. But in other times, of course, currently and over the last few months, being overbought is actually very good. And we're going to be focusing on XLK today. And so we have highlighted here in blue, going back to last April, the times when the RSI was oscillating between overbought and really the midpoint. And as all of us who follow technicals closely, we know that that is the best scenario we could have, where we have a confirming momentum indicator in the RSI continuing to stay in the upper half of its scale and really confirming the up move all along. And so the times when that did not happen, no surprises from August to the early start of November here, and then during the most recent pullback in the spring. All other times, if we really just stayed with the trend as long as the RSI was within that range, we were okay. But there are times when we get extremely overbought, and there's no real metric to suggest when this is. From our perspective, anything in the high 70s, especially 80, is considered pretty extreme from this level. And so just over the last few days through June 17th and June 18th, the 14-day RSI for the XLK did hit 80. And as we can tell here, it crept into the mid-70s in the past, just going back again through last spring. But this is the first time it hit 80. Now, the question is, how did this happen this time? And so just looking back at what's occurred since the April low, XLK has rallied 20% in just about 2 months. So a pretty impressive run. And again, through June 17th, it was up 11 out of 12 days. Putting all that together, it produces this pretty extreme reading on its RSI. Now, to go back to see when the last time this occurred to give us some sense of what could happen going forward. Now, we're not going to go all the way back through its history, but just look at the last time it took place, which was on September 1st, 2020. And as you can tell, and as you probably remember, that led to a pretty quick 14% sell-off for the XLK and about 10% pullback for the S&P 500. And so with this, of course, we're not really talking about apples to apples. Coming back from COVID, there were some explosive moves along the way. And so in the preceding few weeks before that, XLK was up about 24% from the end of July, right? So we're talking about 5 weeks worth. So a more substantial rally in a shorter period of time, and it ended with 10 straight gains. And we can tell that this was pretty strong RSI reading for, just about 2 weeks before the top was in. And during that time, we recall that aside from COVID, there were just some really big moves, especially from technology names. Now we know some of them were really speculative, the names that were small cap names that haven't really come back just yet, but some bigger names as well. And along the way, a few weeks before the top, there were two important stocks that made announcements that they're going to have stock splits as of the end of August 31st, 2020. One was Apple, and Apple from its March low through that September 1st high was up 160%. So at the time, again, still one or the biggest stock back then, up that much. Clearly the market was going to follow its lead. Now, the other stock that was going to have a stock split on the same day, August 31st, 2020, was Tesla. Tesla was up 600% from the March low to September 1st high. And so we could see that they both did well enough for the XLK have a strong move on the 31st and again on the 1st, and then the bottom fell out. And so 14% down, rally, another big downturn, and things didn't really subside until after the election. And so it's important to consider because of a short-term risk-reward scenario. Bigger picture, should we really be that concerned? Because again, we go back to the last time it happened, 14%, similar decline. And then by the time the beginning of the fourth quarter, into the fourth quarter happened, things were starting to rally again. And by mid-December, XLK had shot above that point and really then broke out from a 2-month pattern at that point. And then we know that led to 13 more months of gains. And so there's one key difference now, even though we've had that 80 level in the RSI hit. And that's on the weekly chart. And I point down to here, which is the 14-week RSI, and it is overbought once again, but just barely at this point. And we still have a few more days to this week to see how this ends up. But you go back to times from even 2019 into early 2020, and we can see that it got much more extreme and lasted for much longer. You even go back to second time in 2020, 21, 22, and even earlier in this rally, right, from, or I should say last spring to summer. And so we're not quite there yet on a weekly basis, but we know it's only going to persist for so long. When you have the daily RSI at 80, when you have the weekly RSI getting into the 70s, at some point there's going to be a correction, or at least a digestive phase that could reset a lot of these indicators. And so always the question is, when that happens for the biggest names, most influential names, the ones that are driving this market, what happens to the rest of the market? And so if we look at the XLK versus the S&P 500 now, no surprises that the 14-day RSI is now extended again. And really, this is the third time it has occurred since the low of last year. And so in November, in January as well, and then of course now. And so both times, the ratio eventually went sideways back toward the end of the year and then pulled back to start the year. And then an even more pronounced move from late January down to the middle or the end of April. And we know in between that time is when the market pulled back that 6%. But overall, do we really recall the S&P doing that badly at any point during this time? Not really, because this is what's happened since last summer, where we've seen the XLK versus the S&P drop a number of times, but the S&P has maintained its uptrend the entire time. So it tells us that when the helium came out of technology, the rest of the sectors were there, and then money rotated into them. And so, needless to say, we need that to happen again if and when we do see a deeper pullback in technology. Because even though technology has led for most of this run, has been responsible for so much of these gains, it's rotation that's been really the hallmark of this advance. And if the market is going to extend much longer, that will need to persist going forward as well. That's it for today. Don't forget to check out these videos and subscribe, and I'll talk to you next time. Thank you.